The number one reason to be bullish on stocks. Ready for it? All right, so every year or every couple years, this same article gets regurgitated. And I actually think there's some validity to this, which we're going to share with you here. But this is a reason that you should remain in stocks to some regard, and depending on what your risk is, all this. Just remember, the stocks for the long run, in the long run, we're all dead. So just because stocks for the long run has been predicated on basically 1926 to today, that the markets have outperformed bonds in of itself, that doesn't mean it will. Just keep that in mind. Anyway, but I just want to share with you this because I see this article along these lines quite a bit. There's one in the Financial Times that just came out, and I don't have a subscription to Financial Times because I'm not stupid. And I certainly don't follow The Economist or anything like that. Neither should you. How come I can't make this thing bigger? Hold on a second. Oh, that's not what I want. All right, one second. In fact, if you're following The Economist, just leave because The Economist is globalist 101. I guess if you want to know what the enemy is up to, follow The Economist. It's not for smart people. Let's just put it that way. It's for people who want to think they're smart, but they're not. All right, so right here, where have all the public companies gone? All right, this is from Bloomberg a couple years ago. I think it was 2018. Every couple years they rehash these things, and I think I do think there's something to this. All right. The people who supervise the U.S. stock market are grappling with what they see as a troubling trend. One of the great innovations of Western capitalism, the public company, is losing ground. All right. Since the creation of the Dutch East India Company in 1602, the public company has been a central figure of the global economy. It enables enterprises to raise money from the broadest possible group of investors. So a public company, my friends, is not a socialist company run by the government. A public company it has access to anybody to buy the shares and take an ownership stake. You, Finney, Pablo, Charlotte, we can all buy shares in a company and be an owner. Now, your ownership is meaningless because you don't have enough authority in your ownership stake in terms of proxy votes or whatnot to make a meaningful difference. But you still own it. You are an owner. All right, and that's hugely important. Now, why do companies go public? To raise funds for expansion, to reward the initial investors, the initial startup. They can say, hey, look, we got this great new widget company. It's freaking kicking butt and taking names. If we keep it private, just owned by insiders, we can't expand it and we can't make it as profitable to the original investors. So we're going to take it public so we can maximize our rates of return. Nothing wrong with that at all. A founder in his freaking garage figuring out wood gasification turns this wonderful technology into a way to save the amount of energy you're using to cook the food. He's saying, I just can't make this world. I need more money to market it. I need more money because I want to sell it. I mean, all kinds of different things. So I'm going to take it public and let people buy it from me. That's literally what happens. And that's great. That's great. But the problem that we see here, though, lately, the universe of such companies has been shrinking. In 2008, new businesses have been offering shares to the public at a less than half the rate of the 1980s and 90s. Mergers and acquisitions have eliminated hundreds more. About 3,600 firms were listed on the U.S. stock exchanges at the end of 2017, down more than half from 1997. All right. So the Vanguard total stock market is about 3,500 companies. We call it the Wilshire 5,000. There ain't 5,000 companies in there, man. There's about 3,500 or so on any given year. It could go up, it could go down. A lot of companies, will go private. What that means is they'll say, okay, we're going to buy this company. We're going to delist it from the stock exchange. We're going to basically, and if you're working for a company that's recently went private by Bain Capital, Mitt Romney and stuff, get the hell out of Dodge because they're not looking out for you. They're going to try to make that company as Spartan as it can so they can turn around and say, look at us, man. We got rid of all the dead weight. Joe Snuffy, who's working on the elevator shaft. And what we're going to do is we're going to get rid of Joe Snuffy. We're going to farm out all this to a cheap labor in Guatemala. And even though the Guatemalan doesn't know how to run an elevator shaft, well, still it's cheap labor. So it's going to show huge earnings relative to expenses. And then we're going to make it public and we'll make it mint. That's exactly what happens. M&As. And what happens is investors say, okay, I'll buy it because look, that freaking widget company, that elevator shaft company is making money. Yeah, that's great. They do it on the back of the employees. Anyway, so what happens is this is what's been going on. M&A companies have been taking companies that were inefficient, and they do this to some regard. They do. They're not bad at doing it. Inefficient in terms of, freaking price to earnings, to profit maximization, short-term profit maximization, though, at long-term problems. That's what happens with a lot of these mergers and acquisitions. Venture capitalists, short-term profit maximization at long-term problems. And that's one of the best things that Trump did that he could never get through. He wanted to get rid of the stupid quarterly reports on earnings and say, let's just go to annual, because everyone's focused on the quarter. That's all short-term. That's not stocks for the long run. That's stocks for the short term. And that's the whole thing about stocks for the long run. We have the short term, basically, the standings, the short term standings. And if you're a CEO or a division manager and you get 2 straight quarters of bad numbers, you're gone, man. And so they're going to do whatever they can to goose their returns so they can get the bonuses. And they'll kick the can down the road for the problems for other people. All right. So where have all the public companies gone? Well, why has this happened? Well, some blame regulation, notably SOX, the Sarbanes-Oxley Act of 2002, designed to counter the accounting frauds of the 1990s. That can't be the whole story. The decline began in the late 1990s, well before SOX. Much of the earlier shift was probably payback for the abundance of poorly conceived companies that came to market in the exuberant 1990s, 100%. So fewer public companies isn't necessarily bad. Measured another way, the public company is far from dead. Though they've decreased in number, they've grown in size. Market capitalization of companies listed on the U.S. stock exchange. They've grown in size. They've decreased in number. Market cap number, shares outstanding times price per share. Why have they increased in market cap? Basic supply and demand. So let's go into what happens here. Supply and demand. You got the seesaw. All right. So basic supply and demand. And you're going to get this equilibrium, fulcrum, if you will. All right. So we get supply, demand. All right. So what happens when you decrease the supply? Well, you may or may not increase the demand, but you're in terms of the number of overall participants in demand, but the dollars of which that demand represents is going to less supply. The dollars of the demand are going to less supply. So if you have 5,000 stocks, I don't have a thing to wipe this off. Oh man! If we go to 5,000 stocks. If we have 5,000 stocks, that means there's 5,000 companies to choose from to invest our dollars. If that goes down to 3,500 stocks, inherently there's 33% less companies to choose our dollars to invest, if that makes sense. Now, we're not talking pink sheets. We're not talking penny stocks. We're talking the exchange listed New York Stock Exchange, NASDAQ, Philadelphia Stock Exchange, ASE, American Stock Exchange, Chicago. We're talking the stock listed companies, if that makes sense. Not talking pink sheets. Anyway, point being is now you have supply dropping. Demand is still the same, but because the supply is dropping, the demand has more dollars chasing fewer companies. More dollar chasing fewer companies is what? Oh, that's inflation. And just thinking about it like your home. And I said this a million times a Sunday. If you have 20 homes in your neighborhood and 2 are listed, all right? So 10% of your neighborhood is listed for sale. And you only have 1 buyer. So we got 1 buyer for 2 homes. What happens to the price of those homes? They go down in value. 1 buyer for 2 homes. That guy can be choosy. On the other hand, if you got 2 houses for sale and you got 5 buyers, what happens to the price of those homes? They go up because there is more demand than supply. It's just that simple. And what is happening with the stock market in some regard is that we have more, not even so much more demand, even same, but there's actually more demand with more money coming in, all this, with a supply that's dwindling. And now check this out. It's only going to get worse or better, depending on how you look at it. Some zero hedge just from the other day, March 16th. The SEC is proposing to force companies to disclose their greenhouse gas emissions and filings. The regulator, the financial regulator, is now planning on having public companies, we just talked about, disclose their greenhouse gas emissions and climate risks, according to the Washington Post. The new rule is expected to be proposed this week, and of course being headed by Uh, deep economic thinker Elizabeth Warren. That means hundreds of businesses would be required to measure and disclose greenhouse gas emissions in a standardized way for the first time. Now, you might say that's no big deal. I mean, actually, in some libertarian capitalists say that's good. Let's know what we're buying. That's fine. No, it's bad. What does it do? It's just more regulations, more compliance measures that a company has to file. That stuff costs money for companies, especially for companies who are competing for market share from the titans that already exist. So if you're a new company, I think the rule will affect only companies with over 700 million in market cap. 700 million in market cap. I know that sounds like a big cap stock. It's not. That might even be a micro cap. That's not even considered a small cap. I mean, it's definitely small, but it might be considered a micro cap. 700 million in market cap is not a huge behemoth. What, Apple's like 2 trillion? I mean, give me a break. So Apple, with the resources, with the lobbyists, with the lawyers, they can easily put together this stupid climate disclosure. How about whoever's trying to compete against Apple? Can they? This is why Amazon and all the big wigs at Walmart, they all support the minimum wage. Why? I mean, a big minimum wage, 15. Fight for 15. Why do you think they all support it? It's simple, because that hurts their competition. They already got the market share. They already got the lobbying power. They already got the freaking lobbyist. Don't they have? They still can't. They still got to compete in a level playing field. The more disclosures, the more compliance you put on to firms to compete, the less competition there is. And as such, what happens now? The more that the SEC is going to regulate, the less companies are going to go public. The more will go private. They'll say, yeah, screw this. I'm just going back to a partnership. Partnership means privately owned company. I'm not dealing with all this crap. There's regulation, quarterly report meetings. I'm not doing it. So when I was at USAA, I'll never forget General Robles, who was our CEO, and he said that USA was going to get out of the banking. I can't remember what it was, maybe mortgages, I think, because we were just always piss poor in mortgages. He said the cost of compliance is so high, and that he was actually pissed. And I've never met him other than, just a couple of times. I never had a sat down, drank beers with him. I don't know if he's a nice guy or not. I presume he was. He just always seemed grandfatherly to me, and like a nice guy. You know what I'm saying? But at the end of the day, I remember he was doing a meeting one time, and you could just see he was just pissed about the cost of compliance for the bank. And I think USA just got fined too, as a matter of fact. And they're like, we're not going to do this anymore. Actually, let me just see. Did USA get fined? USAA is fined $140 million for bad money laundering controls. Regulators say the bank, which mainly serves U.S. military members, failed to keep track of its customers' suspicious activities reports, SARs. This is what I'm talking about. So what happens is you got the regulatory environment, more regulation, more compliance, more costs, and people are going to say no. So 3,500 companies out there, you're going to be left with these moats of companies, big conglomerates that pay a dividend, that pay lobbyists, that basically buy the regulators to stay off their backs. And those are companies that are probably profitable. Doesn't mean they're competitive, doesn't mean they're efficient, but that is one of the reasons why I'm still bullish, because at the end of the day, you're like, look, the government is reducing competition. Fascism 101. Mussolini, make the trains run on time. Everything for the state. But he didn't take over the companies. He allowed the companies to make money because he knew at the end of the day, the companies know how to best run their franchises. The government does not, but the government will certainly tell them what to do. So you have a bunch of behemoths, and everybody else works for the government or works for those behemoth companies under the name of fascism. And so you invest in these big guys, you're like, all right, at least probably the long term is probably pretty good there. It's sad, but it is what it is, man. We can live in the reality or we can live in the world we want. I choose to live in reality. All right, love to hear your thoughts.